What's up, everybody? Welcome to another edition of the Free Toaster podcast. I'm here today with Alana, Levine, Chief Revenue Officer of Fintel. Alana, good afternoon. Good to see you again.
So good to see you, Carlos. Thanks for having me.
So today we are going to talk about something we've actually never discussed on this show, which is the affiliate marketing on the deposit side of lender relationships. And it just happens to be a category of the business you all serve at Fintel. So having seen this from both sides, the lending side and the deposit side, can you give us a little bit of comparing and contrasting what's similar, what's different about affiliate marketing when it comes to deposits?
Yeah, for sure. I think, there's so many different facets to the way acquisition works on the deposit side compared to the lending side. There's a lot of overlap. Sometimes our clients engage us because they want net new relationships, and the motivation for leveraging affiliates is getting their brand out there and just creating net new accounts. Unlocking, younger demographics, or looking at, how do I address the great wealth transfer and all of those types of things. In other cases, it is about deposits. And so, the products that they're putting out to market and the ultimate objective is how do we efficiently drive deposits because we've tapped out on search or our other channels aren't delivering for us. I think the biggest distinction I would say between lending and depository products is typically the deposit products are a great kind of entry product, building a net new relationship with a potential account holder. But I really think it's actually less transactional than the lending space is. So it is about lifetime value of the relationship. Takes a lot longer to recoup the revenue that you need from an acquisition cost standpoint than what you would from a lending standpoint. So I think that's probably the biggest difference is you're not just optimizing towards, funded loan or funded account. It's those who do it in a really sophisticated way and the channel becomes incredibly profitable is when you're looking at what are the value of these accounts and what's the behavior of these accounts, not just once they fund, but 3 months, 6 months, a year down the track. Takes a lot longer to really evaluate, hey, is this working for us? So that's what I would say probably is the biggest.
Got it. Let's talk just kind of unit economics here for a second. In lending, the most common model I see is CPA. So I'm paying the publisher like a set amount of money per approved customer. I'm guessing in the deposit world, banks aren't paying out bounties for opened accounts. They want opened and funded accounts. Is that the case? And if so, is the payout based on the dollar amount that is funded or just the account being opened and funded with any amount of money? How does it work?
Yeah. Again, there's so many layers to it. I think if a bank has the ability to report on funded, the goal is always to pay out on funded. There are some cases where honestly, when you're setting up tracking, it can be really hard for them to be able to share. You'd think it'd be easy and obvious, but sometimes account opening systems and the way that they have their application funnels, it's not always the easiest. Funding may happen later down the track. So in that case, they would pay out on a cost per account, but majority of the case, it's a cost per funded. Depending on the product makeup, that's where the funding thresholds can change. So sometimes you'll see in the rate tables, it's minimum of a dollar. You've just connected another bank account and you've made your first deposit. In other cases, especially in the CD space, money market space, there's minimum deposits that are required. In which case it could be, a $10,000. In order to access a certain rate, you need to deposit at least $10,000. Now that usually doesn't happen the first time they open and fund the account. It's a behavior that'll occur. Maybe they'll open the account and a week or two later, then they'll e-transfer, wire themselves the money. And that's when the payout happens. Sometimes we do a two-part, if that's going to take, on average, they see 2-week difference between hitting that threshold and when they open the account. We'll do a CPA and then a top up. So there's a lot of different kind of ways to structure it. The one thing that absolutely you don't see is tying to funds, because then that would bucket you in the category of broker deposits. There are such things as deposit brokers that are there really to facilitate introductions and bringing in net new accounts that will come with certain balances, and you have to be licensed. A lot of the affiliates are not, and that's not the intention. But what we can do is optimize and report back and, adjust CPAs based on general behaviors that we're seeing with accounts. So if we're seeing really healthy balances longer term, that might influence what ultimately CPA negotiations look like, or CPFA cost account look like.
Yeah. Got it. Okay. I didn't realize you had to be licensed in order to charge on a basis. Let's say you were licensed. What would be the going rate for, say, a $50,000 deposit account?
Yeah, we operate on we call it a CP1K, so cost per $1,000 deposited.
Yeah.
Affiliates are fairly efficient. I don't know actually what brokers pay. It's usually like a couple of basis points off from what the Fed rates are. So you want to obviously be, instead of going direct to market, you want to be more cost effective than that. But I think affiliates are probably the most cost effective if optimized correctly. And so a CP1K that we target is usually, our goal is to be at the under $10 mark. Sometimes it's a little bit more, sometimes it's a little bit less. Market, this is where I talk about predictability. There's so many factors that influence, like rate changes, competitors entering the market, balance requirements, anything like that changes the product can change obviously what that CP1K ends up being. Consumer behavior and appetite. If rates are dropping, they might shift their money into their brokerage accounts instead of leaving it into these depository products. So all of that can influence CP1K, but that's usually what we like to see is a healthy number in the low teens, if not below $10. And if you would have asked me that a year ago, in some cases it was at like the $7 mark.
So like at $10, if I was a bank trying to do like let's just say $20,000 deposits, I'd be paying a CPA of 200. Is that
Something
right?
like that.
Okay, so 200, which is effectively 1% of the balance for 1 year.
Yep.
And if they held it for 2 years, then I'd be paying 50 bips on the balance. And if they held it for 3 years, okay. So it's the whole game of
the whole game, exactly right.
Yeah. And what's typical? Like what do you normally see folks that are promoting or that are securing customers and affiliates? Like what's a typical duration of the account?
I would say the accounts tend to be fairly sticky. It's what do the balances look like over time. I find in some cases you do get what we call rate chasers. And so they're just rate driven, in which case their balances come and go quite quickly. Younger demographics actually tend to be a lot stickier. It's the boomers are the ones that are very savvy and are just used to moving their money around to different accounts depending on balances.
I would have guessed it was the other way around.
I know, but we've seen differently, yeah. So I think I don't know if it's a sense of laziness or pragmatism that, a couple of half a basis point is not going to really make or break my life. And so I'm just going to leave it. But the balances we typically like to see around the $40,000 mark. So that's like, people who are opening high yield savings. And those are generally for accounts that are within 10 basis points of the top rates in market. So if you're trying to get on an affiliate page and you're drastically lower than what the top rates are, it's really, really challenging to have to try and even compete. It is a very rate driven market.
Okay. In lending, I still see deals that are CPL. Do you see that at all in this space, or is it all pre-funded?
It's usually pre-funded or, like I said, opened account. There's such competition, and it's now expected and so ubiquitous and easy to be able to open an account. There's not any kind of like lead gen engines that are pre-qualifying and then sourcing and selling leads out places. It doesn't exist in the deposit space. Most often the campaigns are the click out campaigns, which is why it's very rare that you'll see a CPL model.
Got it. I'm going to share something on the screen, Alana, with it's from Bankrate. And my questions are going to apply. They're not necessarily intended to be about bank rate because I'm guessing every publisher operates a little bit differently. I'm more interested in your general take on how you think the category in general operates, not so much bank rate specifically. But if we look here, I think pretty clearly labeled. So we're in the high yield. For the folks that are audio only, we're on the high yield savings account of best high yield savings account of March 2026. And then there's a category called best savings account sponsored offers. And they make it pretty clear that these are sponsored offers rated highly by us for competitive rates, fees, and minimums. And then what I found interesting about this is they weren't ranked in order of rate. So Marcus at the top, 3.65, Capital One next at 3.2% APR. And then the best rate on the page is actually this Vio Bank, which is not a bank I've heard of, in the number 3 slot, and then Amex at 3.2. So Alana, can you comment on why you think these brands are ranked in the order they're ranked?
Sure, I'll do my best. A lot of, I'd say, especially in the deposit space, and maybe this is a differentiator from lending, is trust in where you put your money is so important. So these platforms tend to highlight those most well-known accounts. And so that's why even if it maybe isn't the highest rate from a brand reputation standpoint, from the fee standpoint, a Marcus, a Cap One, like those are going to be the ones that resonate most with audiences. A lot of the publishers, as you know, often optimize towards an EPC model, earnings per click. So for them, it's probably likely that people who happen to see a familiar brand are more likely to click through on those brands. And so even though maybe they don't have the top rate, in this case, they've dedicated this space to those that probably perform best, irrespective of the rate, just because of their reputation. So that would be my guess. And I would bet that Vio made it in there because of their rate. So if they're a top rate, they probably have some good budget to put behind getting some visibility in a more prime spot. And they're probably performing well, which means there's an affinity with that audience on Bankrate's site. They've earned their place in this area.
Got it. So with going to your comment on EPC, that's pretty common in lending as well. Either EPC or probably earnings per impression are the two models that I see the most. Is that, let's talk about, I guess, payouts first. Is there a pretty broad range around what brands are willing to pay per $1,000, or is it really tight distribution with the market pretty much willing to pay the same and the differentiator comes around the rate and the brand?
It's a mix of both, I would say. There is a very broad range at the moment on payout model. And that we usually will set a CPFA that then backs into what a CP1K efficiency is. So it's not like they're paying for a certain amount of deposits. They're still paying for the account, but then their expectation is the average balances of those accounts are then going to back into something that is palatable for them to sustain and want to scale. The ranges of CPAs and CPFAs have wildly changed over the last 18 months. Like, I can't even believe it. And it depends also on the type of product too. So obviously checking may be different than a high yield savings or a CD. CDs tend to be more expensive to acquire because they're stickier deposits. They're locked in for a certain time frame and usually have minimum deposit requirements, whereas high yield savings is competitive, so it's expensive, but it's tends to be more fluid. Back, I'd say 12 months ago, you could enter the space comfortably at like $150 CPA. Now I'm seeing CPAs that are for high yield savings in the $350, $400 plus mark for consumer accounts. So it's starting to get quite expensive. And that's because it requires more budget to unlock the larger volumes with these different partners. You could easily run, and we do this as part of our strategy, is usually we'll have kind of like a default CPA rate that, any partner who can drive a funded account is eligible to earn a certain CPA. And you start at that baseline level. And then if you're wanting to unlock partners like, consumer accounts, a bank rate, a NerdWallet, that you're going to have to just fork over more budget because that's where the volumes are really going to come from.
Got it. Can we talk a little bit around application funnels? Because in lending, I see a lot of variability across lenders. The basic pattern in lending is some organizations choose to ask more questions of the user. So there's, the most egregious example of this is like a cash flow underwriting, where in the application you say, hey, I actually want you to link your bank account so that I can learn more about you before I make my decision. While that's great for the underwriting step, it's actually pretty damaging from the marketing side of things because there's just a lot of drop off there. So I guess my question is, how much variability do you see in application rates across the category? Is everyone's process more or less the same when it comes to application flows?
Yeah. We still see considerable variability, which I quite frankly am surprised by at this day and age. It depends on, you have the banks that have built their own application funnels and really streamline and optimize what that looks like. And those I would say are the larger FIs. Every single one of our large bank clients, they've custom built their application funnels. Whereas a lot of times you'll see these kind of high competitively rated products that have purchased or licensed application funnels. And then there's a whole skew of who these suppliers are and which ones tend to perform better because their journey is really streamlined or because they're highly customizable. And so, the banks have been able to optimize. When you get, as an example, a regional bank who now wants to go national to drive deposits to fund their commercial lending business, they see those deposits outside of their known footprint as riskier. And so when they're looking at their application funnel compared to an FI that's very familiar with operating at a larger footprint, their application rates and approval rates tend to be a lot less. They'll flag accounts as fraudulent that otherwise other banks may not. So it's really interesting to see the spread. I find, not to knock, working with credit unions or anything like that, but they tend to be a little bit more conservative with their funnels. And so we see, the same traffic going to some platforms that are getting declined and that same traffic going to another platform's getting approved. And the quality of those accounts, we can see we get that vintage back is quite healthy. So it is really fascinating to see how divergent it can be.
Interesting. Yeah, I would have guessed maybe more homogeneous or more homogeneous flows here, but I guess I hadn't fully thought through like the fraud, the know your customer. There's like, I guess walk us through like what's a normal funnel look like? Like what are the things a customer has to do to open one of these things, and like what are some of the things that the best in class are doing that maybe the average banks aren't?
Yeah. I think it's the normal stages when submitting information and needing to open an account. So it's your usual kind of KYC, name, email, enter your address. If you're looking at opting in for certain products, they'll ask you for which products you want to opt in for. They'll collect enough information to be able to just validate your identity. And that's really kind of what it comes down to. Okay. And then you get approved for the account gets open, and then you're expected to connect your bank account. So a lot of the more sophisticated platforms will use a Plaid or a certain instance to make that happen. Otherwise, you have to send yourself micro deposits, which tends to obviously be more frictionless. Right. So the easiest way to be able to like have your ID checked or enter your last 4 digits of your social and things like that, that are expected behavior and
Yeah.
they have the ability to do their own checks with as minimal information as possible are the ones that tend to win. But a lot of the applications still require a lot of those manual steps.
Yeah.
And the worst is when you're like, great, thanks for submitting this. Someone from our team will review, and then you'll get an approval email. And it's like, what? How is this still happening? Yeah, which is definitely a disadvantage from a conversion standpoint. And that's when you're having to try and spend more with these affiliates, because they're pretty pragmatic. They obviously don't want to send their customers down a path that is just a terrible experience. They, anyway.
No, I get it. It reminds me, your example reminded me of it was like an international money transfer company. I'm not going to name them because it's like super embarrassing. So I'm just going to tell you what happened.
Okay.
But I refuse to use these guys. I refuse. I went through, it looked like a really normal funnel, but I got stuck on the whole ID verification. And they said, hey, take a pic. I was on my laptop, and they said, hey, take a picture of this QR code, and we're gonna I think send you a link, something like that. So I did it, and then the link said, take your picture, which I took a selfie, and then it said, take a picture of your ID. And I think it was just trying to match my face to the ID. And then it said, congratulations, you're done. Like, it said that on my phone. So then I went back to the website and I hit enter, and it just took me right back to the QR code. Do this QR code. And I was like, huh, weird. I thought I already did. So I did it again.
Wow.
And I did it again. And then I just realized, okay, this is like an infinite loop. But I mean, it was to the point, Alana, where I went back the next day, the day after. I tried a week later. Because I was like, maybe their servers are down. Maybe there's something goofy. No, it was an infinite loop, at least in my case. So I can see banks having issues like this.
And you're an educated, now you're as the educated consumer, you want to get to the bottom of it. Nobody else would ever do that.
I don't know. I was just kind of curious because I gave them the benefit of the doubt. I was like, there's got to be something wrong here. Because I figured they have some vendor running the ID check. Mm-hmm. They probably didn't build it themselves. But, I tried enough times. I was just like, okay, whatever. I give up. But these edge cases can really mess up a lender's funnel. And I do this kind of work with my clients all the time in lending. Is I kind of know what the benchmark is, and for like a good credit card, 40% application rate. That's more or less what I'm going for. When I see like 25, I'm like, guys, there's not one problem here. There's like 14 problems. There has to be. And then you go one by one and you find them and you basically pick up a percent or two as you fix them. Yep. There's rarely one thing that's going to take you from 25 to 40.
Yeah.
There's usually like a host of things.
Yeah, I'd agree with that. I think it's the same on the deposit side. I would say the biggest offender we would see, and I see it a lot less now, is logically banks they're risk averse. So they want to try and secure and protect themselves. We were talking earlier about measuring profitability of those accounts over time. They want to ensure that these are healthy accounts. No one wants to spend money to their vendors carrying empty balance accounts. It ends up being a drag on the business. They lose money. So the biggest offenders were those that, wanted to give them access to a rate, but they had to deposit, $5,000, $10,000. At the account open level. And it's like, think about your mother who opens an account. Do you really think on that day, if she's busy, whatever's going on, that she's going to go and immediately put in $5,000? Probably not. It might be 2-3 days later, a week later. And yet your competitors are no one's opening a high yield savings account to not make money. So they're eventually going to put money into this account. It's just a matter of when they have the time to do it. So why create that friction point for the consumer and also for the affiliate by requiring it on the day? And then I think after we did some experimenting, it could show them with the numbers that, hey, actually, look, you had to wait a week or two, but look, the balances are looking pretty good.
Got it.
That it was enough to justify and say, okay, we'll remove it from permanently from the application funnel, but it was an uphill battle for us also.
Gotcha.
Yeah.
I'm guessing some people actually, maybe their first deposit's 1,000 or 2, just like when they open the account, because that's what's in their checking.
Yeah.
And then they have to move money around from a brokerage or what have you. So is there like a contractual date on which the publisher and the bank agree to look at the deposit before the payouts? I'm trying to put myself in the shoes of the publisher and think through, if I send out a click to a partner, how long do I have to wait before I know how much I'm getting paid?
It's usually instantaneous. So it's whatever. Now the payouts cross-per-funded, as long as there's some sort of funding event that happens. And if it's not what we would call a linear process where they can fund pretty much immediately once the account is open, if it's, maybe it gets reported the next day, but it's usually within 24 hours of the application being submitted that they.
Oh, okay.
All
right. So maybe this gets to your point earlier on like the brokerage licenses, but in these, it sounds like if I got a customer that deposited 1,000 or 1 million as the bank, I'm going to pay the same bounty to the publisher.
Correct.
Okay,
We then look at average balances over time.
Right.
And when you're looking at a roster of 20 partners and the average balances of certain partners are higher than others, it gives us a lot more latitude to say, let's throw more budget at the partners that are bringing higher quality accounts.
Got it.
Allow them to do more, build more visibility, leverage other tactics they have at their disposal to drive more volume and increase the volume of those accounts, and maybe not invest in the ones that are limping along.
Got it. I mean, this sounds more dynamic than lending then from a CPA optimization. This is probably, you're looking at this every month, every week, and you're
daily,
adjusting, right?
We're doing daily. Like, I'll give you an example. Our team, if you're wanting to drive $1 billion in deposits in a quarter, it requires daily budget pacing, looking at each of your partners, putting projections of volumes of spend against each of those partners, and optimizing spend and payout. So it becomes very dynamic, almost like you're running a CPC campaign, except it's tied to accounts, and you're looking at the balances, and it requires, in order to do that at that level, it requires the bank or the depository institution to report those information back to us. So it's not something we would have access to. They have to tell us, but it allows you to get super sophisticated with how you optimize your spend, which makes the deposit space quite fun, actually.
No, it does. Yeah, because with lending, you make a loan and you actually don't know if it was good until like 3 years later. So your cycles are just so delayed relative to when you book the customer. Here, within days, right? You got a batch, if it was what you wanted or not. Your comment on the $1 billion got me curious. Like, what's the normal scale that's achievable within affiliates for, say, high yield savings or checking? Like, what are some numbers you like? Maybe high end of the market or middle of the market? Like, what if I was brand new to this category? How much could I expect? Or how many deposits could I expect to fund through affiliates? Yeah.
I mean, you could fund, it can get expensive, but you can fund it's almost like each marginal additional account will end up costing you more and more.
Right.
Which is why.
Same thing in lending, by the way. So that's pretty normal.
Yeah. But you could generate, billions in a quarter, through the affiliate channel, and depends on how much volume and capacity these partners have to drive, and how much they're willing to send to you. If it's converting, again, it comes down to EPC. So if the product doesn't convert or has a really poor application funnel experience, doesn't matter how much money you throw at it, you're not going to be able to generate the funds. But what's interesting about the deposit space that we learned early on is each institution, because of how the regulatory environment operates, each institution is going to have its ceilings of what's permissible from a growth standpoint. So usually what happens is you get a depository institution that's at a certain amount of threshold from a regulatory standpoint in what they're expected to report, what regulators have oversight over their institution. So we were so surprised when we would hear a bank tell us, we can't go over 10 billion in deposits, because if we do, it puts us into a category that we're not operationally ready to face. So there's sometimes ceilings to what we can and can't do, and usually, and especially publicly traded banks, we have to adhere to the volume thresholds they set for us. So like in some cases, banks are happy getting 100 million a quarter. In other cases, they want a lot more than that. So there's so many facets to how the space works. In lending, it's like you could lend as much as you can as long as you have the deposits to fund it. On the other side of the coin, there's obviously you want to make money off of these deposits. So you need to have, and usually in the banking space, it's commercial loans that are funding this. So we'll have a client that says, we just got a massive commercial loan in and we now need to generate the funds. We're going to look at all these levers we have. We know that you guys can drive X, so we're going to give you this amount of budget to do it. But the other factor is, they can't just, as soon as somebody generates, and I think that was the issue with, I don't want to name names, but there was a very large fintech that had launched a couple of years ago that was like one of the first ever. Within, I think, like 3 months, they generated 100 million in deposits, and the regulators were like, whoa, what the heck happened here? And how did this? And it's because they were they did it through the affiliate channel, actually.
Right. That's cool.
They got in, and their sponsor bank also had some red flags where they had to please explain.
I have some guesses who that might have been, but we're not going to name names.
We can talk about it after.
But that actually segues really nicely. Something I was curious to learn from you. I see a lot of fintechs, neobanks, entering the space now, and I think that the regulatory environment is such that there's a lot of bank licenses. Like if you're watching the news, there's like every week there's a new one.
If we read your newsletter, we would also know about it.
Yeah, we cover some of them, but I'm guessing we're missing a bunch. But my question is, what advice would you give someone that's new to the market that wants to, let's just run with that 100 million a quarter? What boxes do you think they need to check before they enter the market?
Yeah. Are we talking like fintechs that are acquiring their own bank charter, or fintechs that are partnering with sponsor banks? Because
let's go with the latter. Let's go sponsor bank. Let's go. I'm a fintech. I have a sponsor bank behind me, but I want to raise some deposits for whatever reason, and affiliates is compelling, but I'm not sure if I'm ready to enter. Like what would be some of the boxes or some of the questions you'd ask them to know if they're ready?
Yeah. Biggest one, quite frankly, which I think a lot of them have course corrected now, and those that have survived have proven that they can sustain a good business model. But I think it's knowing your commercial model. Like, how are you going to make money? Because the race to the bottom with no fees, no path to actually generating quality accounts and deposits and being able to monetize those relationships, I think was the biggest downfall of that huge surge we saw in fintech neobanks launching. Everyone kind of pivoted to this secured card, build your credit, and there became a subscription model that then they could prove how they were going to make money. But I think if you're like a true depository institution, that's one that I think you really need to think about. How exactly are you going to recoup your money? Because your any kind of transaction fees, merchant fees, anything that you're collecting are going to be split with your sponsor bank and potentially a middleware provider that you're working with. And then the second thing is credibility. Like, you're going to have to spend on brand because, like I said, when you're desperate for a loan or you need a loan as a consumer, you're going to be open to a lot of different options. People know not to go to their big institution because, they're just a number, and it's a lot harder to secure funds there. But, when you're thinking about where you're going to put your own hard-earned money, the alternative fintechs you're going to get like the first movers in market that are experimental, but it's going to be hard to hit critical mass unless you spend quite a bit on brand, which can be costly. So those are the two things I would think about: is how are you going to position yourself or differentiate yourself? What are the features of your product that are going to be compelling, and how are you going to make money?
On the brand question, would you advise folks to run brand marketing while they're doing affiliate marketing, or do they really need to be in the market for years building brand before they can credibly source deposits and affiliates?
I would say it's lean on the affiliates, but do it in a media model, not just on a CPA model. Because what you're doing is, we've talked about this, you're asking the affiliate to take on all of the risk with no guarantee. So if you are willing to benefit from and capitalize on their credibility and getting those endorsements from them, and the market education that comes with working with some of these editorial partners. And we haven't even touched on the LLM space, but leveraging these partners, we're doing a lot of like sponsor campaigns where we're basically strategically creating content calendars with publishers that are with the sole goal of trying to unlock prompt visibility for some of our clients. But it's like, spend the money strategically with these affiliates to help build that visibility, because then you become part of that consideration set. And if you have someone credible talking about you, then it piques their interest enough to say, okay, this seems interesting, someone's talking about them that I trust, they seem to have good features of their product, I'm willing to look at it.
Got it. There's a dynamic that one of the things you mentioned on kind of like the brand not being mature enough. It made me think of, in lending, if you mis-execute affiliate marketing and you end up at the bottom of the page, you actually may end up with negative select, and you may end up losing a bunch of money. So sometimes it's better to not do affiliate marketing at all in lending. If you're going to do it badly, it's better to just sit out. Is there any kind of parallel in the deposit space?
I think it depends on how strict maybe the sponsor bank is with the quality controls in the funnel. If you haven't tested your funnel, definitely not. Don't touch affiliate till you have, and you get some predictability. Like, test your messaging in socials, in your owned channels, test it in paid search, work out the kinks, and not just from a marketing funnel standpoint, but also what your sponsor bank is going to accept, and the quality controls that they have in place, because you're beholden to them. And I think then once you figure that out, then there's less risk maybe than in lending to get listed in these partner sites. Yeah, I would say less.
Yeah, okay. Yeah, because there's I'm trying to imagine the failure mode where you bankrupt the company, and I'm struggling to imagine that one, right? Because if your funnel doesn't work, then you simply just don't get the new customers and the deposit. But it's not like when you make a bunch of bad loans, like all of a sudden the company's out of business.
Exactly. You may be out on a sponsor budget that you threw at an opportunity.
Right.
But yeah.
Okay. Are there any benchmark conversion rates you would advise a potential bank to look at, or like how do they know they're ready? You made the point earlier that work out the kinks in search and social, other channels. I'm guessing the click to funded rate is probably an indicator. Is there a benchmark rate that if you're above, you're probably like good enough to get started?
Yeah. I actually have to talk to the team about what the latest numbers would be that we're seeing, but I'd probably say gut feel like 5 to 10% click to funded is a good threshold. We don't want to see drop off, so like it shouldn't take a lot to get to that app submit, like click to app submit, and then the app to approval should also, like, we have clients that have a 70 to 80% application submit to approval rate, or to funded rate. So like if the funding experience is good, you should have a pretty high conversion rate there. So it's like where we usually see drop off is if the landing page sucks and there's a ton of distraction and they don't end up even initiating an application, like that kills the application rate. Usually we want a dedicated product landing page. Don't throw a bunch of other products at them. So usually, like, some of our clients will like to bundle products, which is fine, but put 2 products. Don't put 5 different kinds of products. Mm-hmm. Some of them will have jumbo deposit accounts and, no fee accounts, and they all just get thrown into an application, and that also will end up paralyzing someone into stopping the application.
Gotcha.
But yeah, I would say our expectation is that those that end up clicking through should submit, and then the app to approval rate should be pretty high in the like
Okay.
80% mark.
Okay. Before we wrap today, I'm curious because I was looking through a lot of the publishers I normally work with, and many of them have either CD or checking or some kind of deposit sections on their site. But it's really hard for me to tell of the publishers that serve this category, which ones are the largest, like doing like the most volume. Do you have a sense of that? And is there anything you can share around like largest players? If I'm new to the market, who should I be talking to?
Yeah, I'd say they're the obvious suspects: the nerd wallets, the bank rates, consumer accounts, lending trees. Investopedia does quite a bit. And then there are...
They're not on my radar at all for lending. Investopedia is like...
Yeah.
That they never make the top 10.
Yeah.
That's actually... Yeah.
And they'd be up there.
Yeah.
And what's interesting is, what you were talking about earlier, is like you could go to these sites and want to see who your competitors are or who's listed on these different pages, but it's dynamic. A lot of these placements, what you see at 1 hour of the day in one geolocation is going to be very different than what, you know, your colleague across the country might see on Bankrate's high yield savings page at a given point in time. So it's, you know, another one I mentioned, which you would say in lending, is Best Money. They do quite a bit too.
Got it. Yeah.
But all of these guys are very dynamic. And then we didn't even talk about SMBs. We're just talking consumers, but
right.
SMB space is a totally different ballgame altogether. Same player.
What are some of the key differences? Like just very high level.
I would say, I mean, definitely the mix of partners is different. I would say those that do well in that space, because it is also fairly saturated, they tend to work more in a CPC model, actually. Consumers also, but I think there's so much more predictability and there's a lot larger volume. So a lot of the affiliates are willing to work on a CPFA because they know what their EPC rate will back into. Whereas in SMB, there's not as much volume, so it's harder. So to compete, like we tell a lot of the brands, you have to be willing to work with these partners on it.
Oh, because the publishers aren't willing to take the conversion risk anymore.
Correct.
Yeah.
Exactly. And there's like other players in this space that we see really large volumes from that have like spin up sites that you wouldn't know about. So there's agencies that run like click out traffic campaigns on like a top10businessaccounts.com. That's not a known publisher name, but it lives in an ecosystem of a like strategic, like I'm thinking like an Applied Mind or something like that, you know, they operate that way. So it's you're unlocking different traffic sources in different ways. But it's because you have to hone in on a much narrower audience. Right.
That makes total sense. Is there the dynamic nature of this is different from lending? Because there's no real need to be checking. I mean, for the most part, like checking daily, weekly, it's like not as needed. Are people tracking this with software? Are they going to the sites themselves? Like, how are these deposit institutions keeping a pulse on what's going on in the market?
I mean, they definitely will go to the affiliate sites. You go to any like FDIC resource. There's databases where, you know, dynamic pricing is listed at any given point in time. They have pricing committees that are monitoring this stuff on an hourly, daily basis. So there's a ton of resources. All of this data for the most part is public. It becomes, and there's agencies that just focus on pricing strategy, which is super interesting. And so there's consultants that come in and help the banks create pricing strategies based on what their commercial lending book of business looks like. Yeah. So yeah, I'd say marketers probably they're either getting fed reports internally by analysts or they're doing their own research and they're, you know, going to the LLMs or they're going to these different pages because they want to see where their competitors are showing up and kind of what the general rates are. And then it's not like a marketer can say, let's rebundle this product. It has to go to the business line, then it has to go to a pricing committee, and then the new product gets approved, and then it has to get rolled out, and it has to get rolled out everywhere. And that's where compliance becomes challenging too, because Compliance, if you have rates listed everywhere, then that's a whole other thing you have to worry about, is making sure that your partners are keeping it up to date.
Is it materially different than lending? Because I think APRs are changing all the time. You have that same problem in lending. Is it more acute and pointed in deposits just because of like the rapidly changing nature of this?
I would say so. I think on the lending side, you get like ranges or things, so it's a little bit easier to it's more of the disclosures and the language that goes with the offer. Whereas, the very black and white on like, what is the offer?
Yeah. I mean, the page we just looked at with bank rate, it was like down to the basis point. It was like 4.09%.
Yep.
So if that was off by 1 basis point, is that a compliance concern for the
big time?
Really?
Guess what happens? Someone looks at that and they go to the bank website and they're like, I was promised here that I was going to get this. They complain to customer service.
Yeah.
Customer service files something with risk. And then before you know it, you've got a whole please explain situation.
Oh, man. Okay. All right. Yeah, no, I can see when you have 10, 20 publishing partners and you're changing rates all the time, how this can be a really headache. So, that's probably why you built your compliance platform at Fintel.
Correct.
Is that in this category? Do people come to you for the compliance solution, or are they looking for your help to get new partners, or is it a little of both? Like when people knock on your door, like what problem do they usually need you to solve?
The volume and the partner challenge. I can't tell you, they want to know how they can work with these big publishers, and that's the first kind of entry point.
Got it.
And then once they figure out what the unit economics can look like, it becomes more of a compelling opportunity altogether.
Yep.
And then I think they just assume the compliance piece. Oh, you'll have that covered, right? And then it's like, yeah, okay, we do.
Yeah, got it. Okay.
Yeah.
Okay, so it's the account growth and that's where the need's coming from.
Depends on the sophistication of the FI, honestly.
Yeah,
that's
gotcha.
the thing.
Do you have a sense this will be my last question because we're coming up on time, Alana, but we could probably talk about this for another hour. Do you have a sense for what percentage of the marketing mix is covered by affiliate? Is this like 10% of new customers? Is it, because in lending it actually tends to be pretty heavy, especially when you look at fintechs. I mean, lenders I speak with can be anywhere from 30% all the way up to like 65 or even more on affiliate. What's the concentration here in the category?
It depends on, I would say, the size and the sophistication of the institution, and also the longevity of the product that they've been running. So I don't want to open this can of worms, but there's a lot of brick and mortar banks that have launched digital banks just as a deposit lever. In which case they haven't really experimented much with other channels. So it's really honestly between paid search and affiliate. So in those cases, affiliates could be 60 to 80% of their funnel. They also probably have broker deposits that they work with and things, but I'd say the safe number is similar to lending, like 30 to 40% of the funnel. It starts usually as very small at like 10%, and then budgets get shifted around as they start to see efficiencies with affiliate. So most FIs we talk to say we're tapping out on search. Most of our volume is coming from search. We need something else. We need to diversify. And that's when affiliates come in and we end up eating more and more of kind of the budget lunch. So I'd say a healthy spot is, 30, 40%, but it can be more also. And even
got it. Positive. It's more than I would have guessed for sure. Because I would have guessed, I was imagining like the Amexes of the world or the Capital Ones of the world or the Chases of the world that have really broad mixes of media, like TV and branches.
Yeah, I would say that's a different,
they're probably in a different
thousands
category.
Of branches. There's probably a significant portion of their deposits that come through there. If I look at digital banks, that's kind of my lens of what I'm thinking about.
Got it.
And then it's a pretty big. We've had big FIs.
Is direct mail a thing in this category or not really?
Not as much. See, we talk about mix of deposit products. You'd see a lot in checking. If you
Yeah.
want to be the PFI, primary financial institution for
Yeah.
a consumer, you're going to throw a really exciting, sexy offer, and you're going to put it on, blast a certain community, or like even
Yeah.
get where your penetration rates are. Yes, you'll see that, but high yield savings, no.
Yeah, no, I've seen the primary checking offers in my mailbox, but they're few and far between. Like maybe once every 2 years I'll get one, but credit cards, like reliably every couple months I'll see one. So it's definitely on another level. Alana, for anyone that listened to this episode and wants to get in touch with you, maybe discuss this more, what's the best way to reach you?
Any way they want. Emails works, Alana@fintelconnect.com. It could be LinkedIn. Find me on LinkedIn, Alana Levine. Yeah.
Cool. Easy. I'll post them both in the show notes.
Wonderful.
This was fun, Alana. Thanks for coming on. If there's interest from the community in digging more on this, ping me. I'm at Carlos I have a free toaster email now, so I'm going to give that one. Carlos@thefreetoaster.com. Subject line deposits. Let me know your questions. If there's enough interest, we'll do another round with Alana.
Wonderful.
So cool. With that, we'll wrap it. Have a great rest of your Monday, Alana. We'll talk soon.
Thanks so much. Same to you, Carlos. It's been fun.
I want to take a quick break in the action here. If you want to support the show, the number one thing you can do is go to thefreetoaster.com and sign up for our newsletter. You're going to get a couple pieces per week of news, information, insights, and podcasts like the one you're listening to right now at the intersection of marketing, lending, and technology. That's our niche. We don't plan to go outside of that. It's the only publication I've seen out there on the internet that dials into this zone. So if you want to support us, sign up and share it in your favorite Slack channel.